entrepreneur in me always wants to disrupt traditional models.
If you're going to go disrupt something which is trust-based, you're not going to do it overnight.
We're at an incredibly exciting crossroads. Find me another industry that has low single digits penetration by disruptors and you'll struggle.
Joining me is Tim Levene. Tim is CEO of Augmentum Fintech.
Augmentum is unusual just in structure. We're the UK's only publicly listed fintech fund, but we invest in early stage, Series A typically, fintech assets. I think we all learn a hell of a lot more when things go wrong than when they go right. If any VC tells you none of their companies are keeping them up at night, then they're lying. So you can have the best product on earth, but unless you know how to navigate the complexities of these huge institutions, it's going to be very hard to get to any scale.
Having a dose of humility as a VC is always a good idea. So good afternoon, ladies and gentlemen, and welcome to today's episode of Couchonomics with Arjun. Joining me, or beaming in from London in the United Kingdom, is Tim Levene. Tim is CEO of Augmentum Fintech, which is quite an unusual investment, venture capitalist, private equity player. They'll explain Tim will explain who they are. So with that, let me sort of welcome Tim to the show. Tim. Hello.
Arjun, great to be here. Thanks for having me.
And thanks for coming on, right? We've never met in person or ever had a previous conversation. We have a common friend or an acquaintance, which is Amir Nurila. I reached out to Amir and I said, 3 seasons in, 150 episodes down, I wanted to go a little bit more global. And I said I'd be interested in getting interesting people on the show. And, your name was right up there and I wrote to you and you were kind enough to accept. So thanks a lot again. Tim, I think it would be great if you start with Augmentum itself, right? I think you have, at least in my view, a unique sort of operating business model. So if you could sort of introduce Augmentum and, we'll sort of go from there.
Absolutely. Well, congrats. On the 150, that's a great milestone, and thanks for giving us the opportunity to share a little bit of our story and our role in the fintech industry over the last 20 years or so. But Augmentum is unusual just in structure. So we are listed here in London on the main market. We're the UK's only publicly listed fintech fund, but we invest in early stage, Series A typically, fintech assets, predominantly across Europe, but we recently made our first investment in MENA, a business called Pemo, based in UAE and recently launching in Saudi Arabia. We have 27 assets, and I think the beauty of the model is the traditional venture capital vehicle is raise a fund, invest for 3 to 4 years, then focus on realizing those assets and raise another fund. And I think the attraction to do something different. I think the entrepreneur in me always wants to disrupt traditional models. So we listed as an investment trust, which is a closed-ended permanent capital vehicle. And we have about $400 million of permanent capital in the vehicle. And any returns, realizations come back into the vehicle and gives us the ability to recycle that capital back into the market.
Interesting. So you say you're the only publicly listed VC in the UK. Now, correct me if I'm not wrong, right? I'm assuming you trade at a certain discount of the NAV or the NAV. Am I correct at that assumption? And if I am, is there a degree of sort of investor skepticism associated with it? And do the founders look at you any differently?
So good question. At the moment, we, like many other private equity or venture capital investment trusts here in the UK, do trade at a discount to our NAV, albeit is somewhat driven by the backdrop of the market. It's reasonable to assume that we are in a difficult market environment and have been over the past 2 to 3 years. On the equivalent side, in 2021, we were trading at a 30-35% premium to our NAV. Okay. And in those moments, that is when one finds it more straightforward to issue new equity, raise more capital. So, yes, I think investor skepticism is, one potential a cause, I would say. But fundamentally, European listed markets, and I would say most global listed markets, have been suffering outside of maybe the Magnificent Seven in the US in recent years, and there has been a dearth of those kind of marginal buyers, the institutional buyer as well, and that's kind of led to a little bit of a withdrawal from the market. So I think from our point of view, the structure really kind of stands up because you can be patient and you can take a long-term view, which is exactly what our underlying portfolio companies and founders like. I wouldn't say we've ever had too much pushback from founders. In fact, we look at it as more of an advantage. They like the idea of having that indirect exposure to the public markets, that visibility, that I guess cohort of often institutional investors that can get to learn about the company. And certainly from our point of view, we certainly see the net benefit across the fintech ecosystem. But at the same time, it's not a reason for founders to take our capital because we're listed, but equally very few, if any, wouldn't take our capital because we're listed. The disclosures are more on the trust as a whole rather than anything in particular about the underlying companies, other than obviously sharing their progress to the wider market.
No, so that's excellent. So you've opened up a number of avenues for me now to go right into. So we'll take a step back. I think first let's talk about the fintech sector itself, right? I think you're a fintech focused fund, right? You've been, as you said, in the market for you said nearly 20 years, right? I'm not asking you to paint a picture of how things have changed in 20 years, but definitely in the last few years. What's kind of your view from an Augmentum perspective? What is the sort of state of the nation of fintech? You can use Europe as the context or a wider view. I'll leave that to you.
I think we're at a incredibly exciting crossroads. Of course, the fintech market has had ups and downs over the past few years from a market perception point of view, from a valuation perspective. I think our view is, do we fundamentally believe that this is an industry that is going to continue to digitally transform itself? And are those disruptive, innovative businesses going to continue to play a material role? And I think the answer is an overwhelming yes in our view. Because if we look at where we are in the cycle of disruption, financial services is an industry that is one of the least disruptive markets globally. And we can just look at the data. Depending on how you cut the market, we can talk about it as a $15 trillion global revenue pool with one of the highest kind of gross margins, close to 20% gross margins. So you've got about 3 trillion of profits to attack. You've got 15 trillion of revenue. And yet penetration by the disruptors is still sub 5%. Now, find me another industry that has low single digits penetration by disruptors and you'll struggle. So yes, we've seen on a global scale hundreds of very valuable fintechs being built. But if you look forward and say, well, how many more are going to be built over the coming 5 or 6 years? We would estimate that 400 billion of fintech revenue currently in the market will grow to 1.5 trillion between now and the end of the decade. So you have 3 to 4x growth coming in this market over the next 5 to 6 years. And that's incredibly exciting for a set of investors that have deep domain expertise, that have ridden through cycles up and down. But fundamentally, I think this is an industry that's showing the first signs of maturity. We often call the moment we're in now at the end of the beginning. And I think the naysayers 2-3 years ago would say there's a lot of hype, there's a lot of noise, but when are these businesses ever going to be profitable? And I think we're hearing very different narrative now from those same analysts that were the naysayers. Now they're saying, we can see these businesses are profitable, but for how long are they going to be profitable, and how big can those profits be? So I think we're in a really different moment in time now where the thesis has really played out. I think there are a number of sectors within fintech where frankly, FinTech 2.0 will have learned from some of those lessons of the last few years and do it better, and in many cases bigger than what we saw previously.
Okay, so let me, I live my life in fintech from a different angle. I've had the fortune of setting up one, running it for about 4 to 5 years in a captive environment. I've been advising banks. I've sat on several advisory boards, and I've been foolish enough to have invested in quite a few of them too. Not necessarily all bad investments, I must say, because I don't want the investors to know that I've invested. I feel that way about it. But here are a couple of sort of questions I'd love to sort of dwell into first, right? 5-6 years ago, as you correctly pointed out, lots and lots of naysayers in the market. The market was very much sort of positioned as incumbents versus the fintechs, right? And one could have argued that people were evaluating some of these digital banks, which needed a lot more patience in a very unfair manner, right? People were like, why aren't they profitable? It's 2 years into their functioning. And to be honest with you, that was a bit ludicrous, right? Because, if you're going to go disrupt something which is trust-based, you're not going to do it overnight. Yes, you could do it with one product here and there. And there was a lot of B2C play. I think valuations did get a bit stupid, if I may use that term. I think venture capitalists had a role to play in that, and that sort of run for valuations. Having said that, the founders weren't sort of squeaky clean themselves in terms of their intent. What I've actually seen is there's two things which I'm actually seeing, and I'd love to get your view on this. One is fintech's rebirth, if I may use that term, and I know it's all very dramatic when I use those words, is we're starting to see fintech now power core infrastructure, right? Which means it's now less about disruptive at the expense of the incumbent, but it's disruption to help the incumbent sort of come along in the journey that was required or needed, either in response to consumer behavior or customer behavior, or in response to regulation. So keen to hear your perspective on that, and do you really see the future of fintech being more about infrastructure and obviously the digital and the neobanks, where there will be true disruption? Second part of the conversation, and this is very interesting because I like to sort of throw out these slightly antagonizing statements once in a while, where I kind of said that, there is this sort of tribalism which still exists with a cohort of sort of the crypto people, right? And my view here is, guys, fintech, there's a word called tech. The nature of that tech evolves. As long as you're driving disruption in financial services, does not matter whether it's incremental or exponential, you're all part of this fintech family. And let's be honest, you at crypto are not going to be able to sit in isolation. And we're seeing enough evidence, right? You see all the stablecoin players who are coming in, they're looking for legitimization. All the exchanges are looking to actually get themselves legitimized. And I don't think DeFi ever will take off unless it finds its place in TradFi and sort of finds to assimilate. So 2 questions. A, is fintech evolving and the future is more around infrastructure? And secondly is, how do you see this crypto wave or digital assets, now if I may use a more legit term, converging with sort of, fintech, or do you see that these two will continue to sort of fight and not want to come together?
Okay, let me try and start with the former. And I tend to agree with you. I mean, I think we look at the market now as a greater recognition amongst the global financial services incumbents that their digital transformation journeys have been long, often painful, and extraordinarily expensive. And the vast majority of capital that they have deployed in their digital transformation has frankly been deployed ineffectively. They are building on top of existing legacy technology stacks that in many respects are not fit for purpose and require fresh thinking. And 5-6 years ago, where there were some viable solutions for, let's call them, some of the largest banks, there was a real inertia, reluctance to engage with these infrastructure players. I think what we see now are those infrastructure players that have deployed technology that is being used at scale. And there is a much greater willingness and engagement from those incumbents to partner. And so what I see going forward is you will continue to have the buy, build, and partner strategy from the incumbents. Yes, they will be very active acquisitors of fintechs over the coming 10 years. And I think that is really important for our ecosystem. Two, they will absolutely continue to try and build from within. And, they will have some success there. They have enormous balance sheets. They invest collectively hundreds of billions of dollars a year in their own digital transformation. But this is an area where I think we will see much more engagement, which is on the partnership side. And we're seeing it today, and we'll continue to see it going forward. And I think that recognition is incredibly important for the continued viability of many of these incumbents, because they are suffering from the classic innovator's dilemma. And they fundamentally have to rethink their long-term business model. But we are now living in a higher interest rate environment where their balance sheets are swelling. And if you look at the top UK and US banks as an example, you're talking about nearly $2 trillion of cash sitting on balance sheets. So they are armed and ready. There's no shortage of people or capital in order to solve their issues. However, these are, in many respects, slow-moving oil tankers that are very, very hard to turn. And that is the challenge that they face. And I think that is the opportunity for fintechs. But I wouldn't rule out that those B2C direct challenges, which we were talking about 6-7 years ago of the fintechs versus the incumbents, that will continue to play out. And I think we'll see some big winners there that don't exist today, or if they do, in a small way. But as an investor, you play both sides. We want to back the B2B infrastructure players that are help solving the problems of some of the biggest financial services institutions, alongside backing some of the next generation B2C platforms, whether that's in banking, whether that's in lending, whether that's in wealth management. I think there are opportunities to capitalize on. So for us, we're agnostic, but we're very objective and eyes open. And I guess on the overlap with crypto, digital assets, and traditional financial services, traditional fintech, I think you see more of a disconnect in the US. I think you see a little more overlap in Europe. I think it's always been clear to us that if crypto is going to play a long-term viable role, it needs to continue to institutionalize both its infrastructure and the underlying regulation. The view that you can play fast and loose with a financial services product is short-sighted. And I think we've seen many high-profile situations that have fallen down on that lack of regulatory oversight. At the same time, this is an asset class that creates nervousness amongst regulators. And I think we've seen a bit of flip-flopping over the last 5 years in different markets around the world. Some embrace, some resist. New government comes in, then they embrace it again. And I think we're seeing that shift now in the US, which has become very crypto-friendly under the new administration. We've seen a lot of progress in UAE in particular, Abu Dhabi and Dubai, that has really kind of looked to attract a lot of talent alongside Singapore. And I think Europe has played some role. I think Switzerland, obviously, has become a bit of a hub. I think the UK has been quite schizophrenic, if I can call it that. We have seen quite a positive statement on digital assets by the government in the last couple of months, and we'll see if that plays out in delivery.
Okay. No, and I sort of agree with you on that. So I was in a conversation with someone from SBI Digital Assets Holding, on the show, and that was the question I had, was that, we have people across the regulatory spectrum, right? From people who have been, if I may say, encouraging to those who have completely stayed away. But the beauty of I guess digital assets blockchain is this ability to make it interoperable and global. So unless we don't achieve some level of regulatory harmonization and some really legit global players coming into play, I don't really see mass scale digital asset adoption for a number of reasons, right? And security, privacy being one, custodies of asset and so on and so forth. Maybe we'll come back to it, maybe we won't, but let me get a little bit deeper into Augmentum. So here's a question, and maybe maybe there is no answer to this question, which is sort of different enough. Does your operating model impact how your investment philosophy is shaped, right? Do you stay away from, if I may say, higher risk bets? Is it very much geared towards long-term sort of plays? How does your business model impact your investment philosophy? Is a simple question.
Yeah, I mean, I think the business model is pretty similar in many respects to a Series A, more traditional GPLP venture fund. We're taking a long-term view. I think our philosophy is, if we have a structure that allows us to be patient, and we believe that the business is going to see more growth, and we're not looking to optimize exits in the short term just so we can raise that next fund, that allows us to make really objective decisions that we believe are both in the long-term interests of the company, but also in the long-term interests of our shareholders. And so I think from our perspective, the ability to be patient as and when, but also if the opportunity is there to deliver a shorter term exit than we expected. And we had that a couple of years ago when NatWest came in, purchased a pensions platform that we had funded 18 months previously. And we looked at it objectively and said, in an ideal world, we think there's a lot of growth to go. It's a fantastic return in the short term for shareholders. It seems to us that the founders want to take this step. So, we can sit there and say, let's go again. Let's roll and reinvest. So I wouldn't say that the structure kind of governs the underlying strategy, but our focus is very much, one, find great founding teams that can build long-term viable businesses in the financial services space with strong underlying unit economics. Of course, from our point of view, we aren't particularly excited about heavily capital-intensive propositions. I think there is, in this market, a different mindset than there was perhaps in 2015, 2016, 17, where there was greater confidence that if you build a proposition that shows early product market fit, you can go out and raise tens, in some cases hundreds of millions of dollars in order to build a brand. I think those businesses are harder to get one's head around, because as that early investor, it's not just about saying, do I like the team? Do I like the idea? Do I think they can generate enough positive results to deliver that product market fit? We're also thinking about, well, who's going to lead that next round? Are they going to think like us? And who is going to lead that next round after that? And I think in a market now that has shifted quite significantly in terms of the types of people that are looking to invest and the types of check and size of checks that they're looking to write, that has shifted. And I think for us as that early stage investor, we've got to look 2-3 years out to say who is going to really help the business go to that next level, which we will continue to support. We absolutely want to follow our money into our winners, but fundamentally we need that third-party validation in the market, and that is, helping inform the types of businesses we look to back in the current environment.
Okay, so begs a couple of questions, or at least from an explanation perspective. You actually mentioned the term, I think, partnerships. You also sort of alluded to the fact that, a number of these financial institutions are, sitting on top of sort of lots of cash, which they can sort of inject into the business. They've appreciated, they understand that, transformation is now imperative, and I think AI comes in as a massive catalyst of change. I don't think you can sort of hide behind, I was in a roundtable 3 days ago where I kind of said, we had the internet wave. Most banks were slow at adopting internet banking. Some of them had actually a pretty crappy proposition. We then had the mobile wave, and I can tell you even today there are banks whose mobile apps are abysmal. We had the cloud wave, and banks still kind of did not adopt cloud in its truest sense. They hid behind data privacy and data residency and stuff. I don't think AI gives you that option. I think AI is kind of like, the chasm between, if I may say, the leaders and the laggards would become pretty wide, right? And I think that is catalyzing a very different attitude among banks. Again, my bad habit of sort of a long-winded context to the question. The question here is, do you partner up in different ways with CVC arms of banks to seek that validation, to sort of get them involved either in the fund as equity owners earlier enough, or starting to see some exits down the line? How do you see the CVC market shifting in the markets that you worked in, and how do you operate with the CVCs?
So I think we've seen a pretty significant evolution of CVCs over the last decade, and they tend to come in waves. When the market is hot, you see a explosion in CVCs, and then when there's a sell-off in the market, you see real attrition. And I think we're in that kind of attrition moment right now. If I look across the portfolio, I would say about half of our portfolio companies have on their shareholder register a strategic investor of some kind, or a CVC. I think they can play an important role, but I always say both to the founders and to other venture funds, go in with your eyes open. It is as important to choose the right CVC as it is to choose the right VC, because the last thing you want are a lot of promises from a bank CVC that in 2 years' time might sit there and say, our CEO's changed, our whole venture team has changed, and by the way, we're shutting down and fire selling the portfolio. And all that stuff we promised you, unfortunately, that came from someone else. And we see that all the time. I mean, there are multiple data points. But they do have a really important role to play, and they can be a very powerful and valuable partner in the right environment and in the right situation. So I think we are very eyes open. As I said, I mean, I've been involved in the European tech space since 99, both as a operator, founder, business builder, as well as an investor. So I think we've seen a fair few waves over the years. And I think you go in with a healthy dose of cynicism, but recognize that for certain models within financial services, it is really important to have the buy-in of the incumbents. I would say capital markets is one really good sector where ultimately, for many of these capital market propositions, fintech propositions, your end customer are incumbents. And you need to know how to navigate your way around those institutions and organizations in order to have an effective sales process. You can have the best product on earth, but unless you know how to navigate the complexities of these huge institutions, it's going to be very hard to get to any scale. So that for me is an area where increasingly, we would feel very nervous to go it alone without some underlying support from those institutions, or where the founders have deep domain expertise and deep relationships in those sectors, where they can pick up the phone to senior person at JP Morgan, Goldman Sachs, Morgan Stanley, Deutsche Bank, and say, here's what I'm building. Who should I be talking to? How do we navigate through this bureaucracy? And I think that's really important. And I think we've seen that firsthand.
Okay. And from your own portfolio, so you said you currently have how many assets? You said 27? 27 in your portfolio. And sort of how do they spread across in terms of the, sectorial focus, value chain? Is there, and has that shifted in the last couple of years?
Well, like with any portfolios, they take time to build and they evolve, especially in our structure. So we exit opportunities and then it gives us the opportunity to invest into new opportunities. But I think with our 27 assets, the ambition was always to give that broad diversification across a number of sectors. So we want to make sure that we have not just geographic diversification, but sectoral diversification. So that would break out to infrastructure, to digital banking, both consumer and SME, asset and wealth management, insurance. These are kind of those core areas where, you want to make sure that you have that underlying exposure. Of course, payments as well, where we've seen a couple of businesses come in and new businesses, the businesses go out and then new businesses come in. So we're always looking at where are we light. And if you'd asked me 2 years ago, ago where we were underweight, I would have said, well, one of our core thesis on IPO 7 years ago was insurance. Insurance is due huge disruption. Our reluctance to invest in the sector wasn't because we didn't fundamentally believe in the structural challenges, but with many of the solutions that were being proposed, we were uncomfortable with a lot of the B2C unit economics in businesses that were being built. And then on the B2B side, there were a number of what we thought were compelling teams offering compelling solutions to an industry that wasn't ready to engage. And we would say post-COVID, you saw a real shift in mindset in that B2B or B2B2C world when it came to insurance. I think there was a recognition that the traditional businesses in insurance had not at all digitized. They were years behind the banks, and we can argue that the banks were lost in time as well, but the insurance industry was in another century. And I think we've seen that shift. And, we're quite excited about what we are calling InsurTech 2.0. Mm-hmm. I would say InsurTech 1.0 was largely a disappointment when we look at the billions that was deployed into the market, tens of billions, I would say. I can't think of, and I might be corrected by one of your viewers or listeners, that there's been a unicorn exit in InsurTech in Europe or MENA. I think we've seen one or two IPOs, obviously in the US, haven't gone particularly well. But I'm pretty optimistic about what the next 5 years will hold for the InsurTech space, because I think a lot of lessons will have been learned from founders. And we're seeing founders go second time round. We're seeing a lot of senior employees that have come out of those InsurTechs and had that experience, seen the good and the bad, and are saying, I want to go again and I want to do it differently. And I think the market is now ripe for that.
No, I think it's. I'm no expert in InsurTech, to be honest with you. I'm quite distant. I used to work at AXA. I worked for them for 5 years, actually, as a matter of fact, in Europe and including the UK. And I was kind of deeply embedded in the business side of it, more on the product side of it, rather than product and distribution, rather than the, if I may say, the data and the actuarial side of the business. Having followed insurance, at least in a number of markets that I've operated in, you're right. It's been ripe, ready for disruption for decades, but very little has happened. I think a lot of it has to do with the fact that the erstwhile insurance companies haven't been open. I think a number of the plays which came out in a number of the emerging markets were largely distribution plays, right? It was about, there's a significant sort of untapped market. So even if you can get the Mickey Mouse product to them, right, and price it at a rate which is attractive, we grow the market. We're now starting to see value chain plays. I think there are some very interesting value chain plays where they are specific InsurTechs which are solving for specific problem. My only question mark with these people tend to be, how scalable is your model, right? Unless you are willing to and able to go multi-geography, right? Scaling is a little hard. I remain cautiously optimistic, but I think I have a very sort of strong MENA view on it rather than a European view. And I think, we're definitely seeing a lot more InsurTech in Europe. From a portfolio perspective, that's interesting. I do want to come into, because I didn't hear the word digital assets or crypto in your portfolio, but I'll come back to it. From a geographic perspective, you're pan-Europe, correct?
We are pan-Europe.
Right. And any particular part of Europe beyond I don't know if UK we consider as Europe, but just let's keep it as Europe.
Right now. Part of Europe, not part of the EU.
Right. So any particular country that interests you, excites you in terms of, the disruption happening there?
So I think what's been interesting in the last 5-6 years in Europe is the emergence of these pockets of innovation. Now, clearly, London remains the hub of innovation and has, the highest number of unicorns. 50 cents in the dollar of all fintech investment in Europe happens in the UK. So being based in London is the right place to give you that visibility. But at the same time, one needs to look, beyond London. And the question is, when you've got a small team, how do you focus? And I think it's the same old scenario of when you have an outlier success story in a certain city that creates that recycling effect. And we've seen that in Holland, in Amsterdam with Arjun. We've seen that in Stockholm with Klarna, and we've even seen it in Tallinn with the likes of Wise and even Skype, that are kind of creating these exceptional talent pools and capital pools as well. Those angels are recycling. So for us, those are really important cities where, why are we seeing so many payment startups in Amsterdam? Why are we seeing so many fantastic, lending, digital banking ideas in Stockholm? Well, it's exactly as a result of these enormous success stories that come out of these big businesses. And of course, we're seeing hundreds of very talented younger people come out of the likes of Zopa, Tide, Monzo, Revolut now, looking to build that next business. And obviously, we're tracking as many of them as we can. So I would say for us, where are the cities where we're seeing, exceptional cohorts of founders coming for that next phase? I would say London, Paris, Berlin, Stockholm, Amsterdam, but also cities such as Warsaw and Tallinn and Sofia, where there's been a lot of tech talent. Of course, in many respects, if it's a consumer proposition, they've moved more to Western Europe, but it's important that we have coverage of those markets. And, as we know, when it comes to financial services, Europe is a very significant hub. The only, I would say, true European champion so far that has been built is probably Revolut, who are obviously looking to go well beyond to become the global champion. But I think in fintech, you can build very significant domestic businesses. And I think we will continue to see some very big domestic winners, but also some regional winners as well. Very few global winners. And I think regulation is that inhibitor that makes those regulators nervous in a particular market. Hence why we haven't really seen that global winner yet. You're not going to see a Google, Facebook, Insta equivalent in financial services, in our view.
No, that's true. And you could argue the case that in traditional banking too. So most of the global universal banks have, even the likes of Citi have sort of, and HSBC have been sort of careful with, where the geographic spread is. Digital assets, crypto, from your perspective, is this something you keep a watchful eye, watch for the regulator, or are you starting to sort of dip your toes into it?
Yeah, I mean, we have dipped our toes. I didn't mention it only because I forgot to mention it in our summary, where we would have digital assets exposure. I would say we have been reflective on our digital asset strategy since 2020-21, where as a publicly listed fund, there is a little bit more visibility and scrutiny on the underlying assets. We've always said we want to give investors diversified exposure to the inaccessible assets that they can't easily access. So giving investors exposure to underlying tokens, which they can freely buy themselves, was not a road that we wanted to go down. I would say our thesis was very much, if this market institutionalizes, this was our thesis back in 2020, then we would rather play a role in the plumbing, in the underlying institutionalization of the infrastructure, rather than playing a role in, which token might win. So I would say our thesis was spot on. I would say our picks and timing wasn't particularly the best, and as such we would have less than 5% exposure to the digital asset space. But I think it was important for us, in particular when it came to the likes of DeFi, to say, do we have both the deep domain expertise, and are we in the right place in Europe where the very best DeFi propositions are being built. And I think in that particular case, we backed a team in the US, a fund called Parify, that are very much at the cutting edge of DeFi, building relationships with some of the leading founders, and that's where we're seeing a lot of that innovation. So that for us was a rare foray into actually investing in a small fund, which is not our modus operandi, but we felt we could get visibility and exposure to a team that would frankly open our eyes up to some of those best opportunities. So, I think for us, we have a lot of deal flow in that space. I think our view is we want to be focusing on either domestic or regional champions, and it's not clear to us that Europe is going to be the big winner in that space. And if that's one of the areas where the US will win, we will have some exposure, but not material exposure.
No, I think that's an interesting point, and I think. Here's a hypothesis to be proven right or wrong, but similar to AI, I think with digital assets, you're going to have certain sort of global infrastructure players, but I do think there will be domestic infrastructure, right, which allows for either the last mile integration or the peculiarities of every regulation being met and kept. I do think that that will require a certain level of institutionalizing, right? But I do think there will, at least that's my working hypothesis, is you will start to see those domestic regional players come up in every market, because the market itself will demand it. Now, whether those founders come from other havens where, that's where they initially got incubated and then find their ways into the UK and the US, into UK or Europe, to be seen, but at least we're starting to see that in the MENA region, and it's strange because we're a significantly smaller market from that perspective, right? I do want to come to MENA, but before I actually come into the MENA, you mentioned something very interesting, right? And it's one of the bugbears a number of founders have always held against the VCs, and it was refreshing to hear your view, which was, do we have the right expertise to sort of meddle in a particular sector, right? And I could say that about a number of VCs, right, where they come with, in my humble opinion, dumb cash, right? They get overly involved with their portfolio companies, especially early stage companies, where I think sometimes the founders are that much more, if I may say, vulnerable for influence. And then they get influenced by, I guess, a bunch of girls and guys who literally don't know any better. And, they're just trying to use the cut and paste mentality, right? How do you engage with your portfolio companies? Is it very much a hands-on approach? Is it sort of modulated to the type of investment? Are there particular sectors where you guys have very strong strength within Augmentum itself? I was talking to one of your peers in the show earlier in the season, so I want to compare and contrast the answers here.
Yeah, well, it's a great question, and it's one that's often asked by founders, and they ask us, what do we bring? And I say, well, every VC will tell you they're more than just money, and most aren't. Now, I'm a multiple founder myself, and the reason that I started Augmentum was I had a deep frustration back in 2010 with the VC community that there was a lot of intellectual talent, but there was a shortage of operators, entrepreneurs, founders, people who had been there and done it. And the view was that if you had been a successful founder, you couldn't get into VC. You could come in and be an EIR and be the entrepreneur in residence and come up with an idea, and then they might fund it again. And that was really what was pitched to me by a number of high-profile VCs. And I was like, no, I want to be an investor. I think I can be. I think I've got something to bring to founders, having gone through a very challenging experience that ultimately ended with a great exit, but there was huge learnings along the way. And I think that has changed in the last kind of 15 years since I've been an investor. I went on a huge learning journey, and I probably early on was too hands-on with our portfolio companies because I didn't know how to be hands-off. And that journey has really led me to learn a lot that we have, deep domain expertise across a number of sectors within financial services. That's what makes, I think, a fintech specialist stand out. But at the same time, we don't have the answers to everything. Yes, we would like to think more expertise, but we don't know, the ins and outs of the derivatives market in every aspect. We understand the dynamics, we understand the key players. And I think we like to play a role where we can be hands-on and helpful where it makes sense. But equally, we're backing teams, and we're backing teams to deliver. We cannot run 27 businesses. That model doesn't really work. And I think for us, we hope that we can have the trust of our founders that when something goes wrong, they pick up the phone, or where something is troubling them, they'll say, hey, we really needed some help through thinking through this issue. It's not about showing up at the boardroom every 6 to 8 weeks and hoping that they're going to come up with 3 questions you can help them with. It literally is ad hoc. Can you help me with this? To give you an example, we had one of our portfolio companies, the 2 founders, co-CEOs, came in Thursday evening. We have one of our team who sits on the board, a very talented guy, but hasn't been around it, frankly isn't as old as me, hasn't had the grey hairs and the trauma. And we sat for 45 minutes and they said, look, here are the 3 or 4 things that we're really not sure about, and what's your perspective? And it was just a really straightforward opportunity for me to say, well, here are the 2 or 3 times where I've seen this situation before. Here's what we did then. Here's how you might go away and think about it. And you're giving them real context. You're giving them real examples. And frankly, you're giving them the benefit of 30 odd years of wisdom and scars along the way. And I think we all learn a hell of a lot more when things go wrong than when they go right. And we've had a lot of those experiences, both personally in building businesses from the ground up, but also investing in them. And I think you take those lessons and you hopefully can apply them in a positive way next time round. And as I said, I think what we got through in 45 minutes gave them real cause for comfort, gave them food for thought to go away and make their decisions. Their job is to make the right decisions. Our job is to help them when they ask. And of course, there are times where we need to roll up our sleeves and there's crisis management. And that happens. I always say to our investors who say, how's everything in the portfolio? Are any of them keeping you up at night? And I always say, if any VC tells you none of their companies are keeping them up at night, then they're lying. It's not a question of if any, it's how many, and how are you dealing with them, and how are you helping them navigate through it? And that's kind of the nature of venture. And I think you've got to take both a philosophical and pragmatic attitude. And when you need to roll your sleeves up and help, you do. And I think we've got the scar tissue in order to be able to do that, but we don't want to unnecessarily interfere. But at times, it requires some of that hands-on management in it, and it sometimes requires difficult decisions. It might involve, transitioning founders out of the business because the business has got too big and there are some very significant operational issues, and you might need to bring someone else in to help the business get to that next phase. But we want to do what's right for all the shareholders, and we're not afraid to make difficult decisions, but ultimately we want to give the management teams every opportunity to help execute. And when you're a minority shareholder, you don't control, so you have to do it through consensus, often with other investors, often with the founders, and that's the playbook, and that's one in which we feel that we've played an integral part in helping the industry evolve. And hopefully fewer people when they talk about Augmentum, they don't talk about they're just money. We really do believe that we're more than that, but we don't have delusions of grandeur that we run these businesses and are pivotal. We are helpful, constructive, and we believe the benefit of the last 25 years of investing collectively in north of 100 fintechs gives us some level of expertise where we can provide some valuable insight.
Oh, great. Having a dose of humility as a VC is always a good idea. So I know we're short on time. I do want to talk about the Middle East. I know you've taken, you made your first investment, I think you mentioned. sort of less about the investment, but more around the region. So what's been the reason? Is this just a one-off, or are you sort of coming in to the region in a more sort of structured and in a bigger way?
So I think it's more the former at this point. I think we cannot ignore what is happening in MENA. We cannot ignore that the digital transformation of financial services has been a little behind, Europe. And I think there are a lot of lessons.
You could say that again and again.
There are a lot of lessons, good or bad, to be taken. But there are some incredibly exciting emerging developing economies there. There is the digitization of these economies. We look at a market such as Saudi Arabia, where you have a significant proportion of young people. You have real embracing of digital financial services. You have an increasing integration into the workforce of women that are taking control of their finances as well. And these are trends that you cannot ignore. I think the challenge we have, of course, is we're not on the ground. I think venture is often a hyperlocal market proposition, and you need to have what we would regard as edge. What is our edge in the market? I think there are some propositions that we think will play really well in the region where we didn't necessarily have exposure here in Europe. And if we know the teams or some of the investors that are behind these propositions, then that gives us real comfort when they pick up the phone and say, look, we would really love to have someone like yourself on the cap table. We think you can provide some expertise and insight to the management team, but also we think there's some fantastic learnings from some of the companies that you've built before that we'd love to kind of replicate here in UAE, in Saudi, in Egypt, or other markets. So I think, again, it comes down to understanding the role that you can play. Being quite cynical if you get the email or the call from an interesting company, you ask yourself, why are they reaching out to us? Are we the 274th person that they've called? Or are they actually saying, you're one of the first people we called and this is why? And you can get comfort that actually you can bring something other than just capital to the table. So I'd like to think that we'll learn a lot from our investment in Pemo. I think they've got an incredibly exciting proposition. They've made kind of great inroads in the UAE, and obviously seeing how they go in Saudi will be fascinating. And, over time, I hope we will be more active in the region. I think in order to build profile in a region, you need to invest. And so that's our first investment. And I'd like to think in time that will be not the last.
No, I don't know the guys at Pemo, but I know the sector well. I've actually worked very closely with one of their peers when it all sort of kicked off. There was, I think there was half a dozen of these guys who all sort of entered the market at the same time. So it was quite interesting to actually see. But I use the analogy that we've got half a dozen Ubers who've all launched themselves around the same time. I do think from a Middle East perspective, I do think a couple of things that VCs such as you who are sort of established, as you said, who have the scars to show for it. I think there are a couple of things which are quite interesting. One is finally we're starting to see decent infrastructure players come out in the Middle East who are solving real problems and solving it at scale. And I think a lot of these solutions can go global, or at least can definitely go beyond the MENA region. And I think VCs like you have definitely a role to play in that. And I think if that company is calling you for that sort of a reason, then I think that is not a bad call, right? Whether you're the number 4th or the 274th, I think it's a call. The other thing is I do think that this market is increasingly inviting for companies which could be in your portfolio, right, which are looking to enter this market. And again, people who are either B2B or B2B2C or sort of quasi infrastructure, I think there is tremendous sort of appetite. But I think a lot of these companies will have to realize that unlike Europe, there is lesser regulatory harmonization in this part of the world, right? A GCC is not a regulatory word to be used. Saudi is very different than the UAE. In UAE, Dubai is very different than Abu Dhabi. And then the unit economics of a number of these countries are very, very different, right? A lot of people sort of paint this picture around MENA. And I keep telling people, before you get into Egypt, think twice, because the unit economics of Egypt, the local talent bank and kind of questions. So I think MENA is going to be an interesting learning experience for you, without doubt. And I think, but interesting things can be done. Tim, last question for you. Where is Augmentum heading in the next sort of 3 to 5 years? Are you going to do anything differently? I'm assuming you're sitting on top of significant powder. Are you going to deploy a lot more aggressively going forward? What's going to be different, if anything, or is it going to be a lot more of the same, but maybe geographically more diverse?
Yeah, I mean, I think for us, we want to continue to scale and grow. I think we've spent the last near decade building out the brand, building out the track record, increasing our presence across Europe. I think you need success stories, and we've had a handful, and I hope we'll have many more. We would like to think that we can be one, if not the preeminent fintech investor in Europe and beyond. I think you cannot ignore the international opportunity, as we said. I think what we need to demonstrate is that we have edge and access in our international expansion, which I hope will come with time, and continue to kind of be an integral part of the ecosystem, and perhaps invest at other stages as well. We have a long pedigree within the team as very active investors in seed and pre-seed. That's not something we do in the listed vehicle, but it might well be something we do in a separate vehicle, a more traditional GPLP vehicle. And in time, we see a bit of a funding gap at the growth stage as well. And I think that's something where we have real ambition in Europe as well, to make sure that we can support that, pre-IPO or even, never IPO businesses, all the way to ultimate exit or profitability. So, yeah, I think scale is important, but scaling in the right way at the right time in the right geographies, takes a considered approach. And we're in a market that I think is looking for exits. It's looking for more poster children in terms of success stories. I think we've seen some interesting IPOs in recent times in the US, and I think we've got a fair few more coming later this year, and I think we'll see more in Europe. And I think that will really fuel confidence amongst those LPs on a global scale. And we need more capital in the market. The opportunities there, as I talked about at the beginning, there isn't, in my view, enough of the right capital in the market at the right stages. And we really want to kind of help unlock some of that capital in the market, both in Europe and MENA over the coming years.
Well, fair enough. All very sensible. Tim, thanks a lot. Appreciate you taking out time. I guess it's still an afternoon for you. Well, have a good Friday and enjoy the rest of the weekend. And if you ever, well, I'm assuming you will be making a trip to to I guess the UAE or Saudi in the near future.
I look forward to dropping in and seeing you.
Yeah, you definitely should, and we'll have a longer conversation. We can get into some interesting investment opportunities out here, because I do think that there are some very investable assets out here. So I want to, with that, thank you for coming into the show.
Thank you for having me.
Right. So, ladies and gentlemen, that was Tim Levene, who's the CEO of Augmentum Fintech. He was joining me from London. Interesting perspective. So we met yet another venture capitalist who is currently not in the region, but is looking at the MENA region, which is great news, because we do want more and more of the, what I call the intelligent capital, to sort of come into the market. With that, I'll say goodbye till next week. Bye-bye.